In this week's episode of Making Billions, I have my friend Drew Breneman teaching you a masterclass on all the tech, underwriting, and due diligence tactics he uses in his $200 million fund. Let's get into it. Hey, welcome to another episode of Making Billions. I'm your host, Ryan Miller, and today I have my dear friend, Drew Breneman. Drew is the founder and CEO of a $200 million real estate firm called Breneman Capital. Drew's focus is primarily on multifamily. His successes here have led him to appear on HGTV when he was recognized around the world as an up-and-coming real estate investor. So what this means is that Drew understands real estate and he understands how to make money and how to teach you do the same. So Drew, welcome to the show, man.
Thanks for having me, Ryan. Appreciate it. Happy to be on. Honored to be on. I think you do a really good job with this podcast and the whole Making Billions community. So looking forward to adding value for the listeners.
Thank you. Yeah, it is a wonderful community. Very grateful. And we are certainly fortunate to have someone with your breadth of knowledge to come onto the show. And we're going to get into all those tasty tips. You just hang in there because Drew is about to reveal things that are going to make your jaw drop. He's going to walk you through all of the stuff that he does to achieve these groundbreaking returns. But before we get into that, maybe you can bring me up to speed. Where did this all begin for you?
Yeah, pretty early. So started an internet business when I was in high school, buying and selling items in a video game called Diablo 2, and just kept all the money from doing that and started reading about what to invest in and tried my hand at the stock market and mutual funds, but didn't really have patience for it being a 16, 17-year-old kid. But then real estate really made a lot of sense. And I've spent the last 20 years on that, where was reading a book called Real Estate Investing by Gary Eldred, and the light bulb really went off for me. He just broke down how to do your first deal, how to manage it, but also how do you actually make money in these things. So he's talking about cash flow and paying your loan down and appreciation and the tax breaks you get, how it's not correlated with other investments. And the appreciation description he had was really a the light bulb moment for me, where he had it's oversimplified now that I've been doing this longer, but it was probably good. It was oversimplified since I didn't know anything at the time. You put 10% down on a property, it goes up 3% in a given year. That's a 30% return on your equity. Obviously, it's not that simple on every deal where you can't always put down 10%, and definitely can't do that on any bigger deals. And they don't always go up 3% a year. Sometimes they go up more. Sometimes they don't go up at all. Sometimes they go down. But that at least was wow, the returns could be high on this, and we're combining a business with an investment together. So, and the returns were high. The risk was lower than the stock market. And the negative with real estate is it's not liquid. So you can't just click a button and get your money out. And it's a lot of work for somebody. So whoever's running the deals.
Man, what a cool journey. I think you mentioned you started when you were a freshman in university. Is that right?
Yeah. So once I got the real estate bug reading these books and said, all right, I'm going to major in real estate. But I was already doing deals by the time I was taking my real estate classes. Sometimes the teachers would be like, hey, Drew, what are you seeing out there in the market for, cap rates or for this or for that? And so they put me on the spot. And so it's kind of, because I was the only one doing deals. Like the teacher wasn't, none of the other students were, obviously. But yeah, so bought my first place when I was 19, a duplex in Madison. And when I was a freshman, and the plan was move into one of the units my sophomore year, rent out the upstairs one and upstairs unit, and then rent out the bedrooms in the unit I was going to live in. So I did that, and the deal went well. Maybe a tip for folks, it worked out great for me on how I looked at the first deal was I try to keep it extremely simple, where I just really focused on two things: how they value the properties and getting that dialed in. So in Madison, everyone was using a gross rent multiplier. And so what that is you just take the annual rents times a number, and that's the building value. And the key is figuring out, seeing enough deals sell and know what's the prevailing gross rent multiplier in the market. Once you get into bigger deals, people are using cap rate and other things, but it's at least at the time. So I figured that out, but I was not sure, am I missing something? Do I not know how this will? I'll say, oh, this is a good gross rent multiplier, but the reason it was attractive to me was because I missed something. So to kind of keep myself safe from doing something like that, the other thing I focused on, and it was just these two things, was that it would be cash flow positive. A lot of people for their first real estate deal, it's extremely complicated. They're going to want to build a self-storage facility in the middle of nowhere, and they're going to be a developer and have to lease it up and do all these different things. And there's a million moving pieces. And one thing that I guess I was fortunate in, I just kind of eliminated a lot of the variables, if you will, and just focused on those two. And then because anybody can figure out rent rents, by looking at what other things they're renting for, and then figuring out the expenses by talking to, your insurance agent, looking up the taxes. So yeah, that was kind of, so then the deals all went well, even though my mindset was sort of, I need to get this first one going. It's my own money. If I make a mistake, that's fine. I ended up buying 4 deals in college, total about $2 million of property. And then I graduated in December 2007. So the writing was kind of on the wall with the economy. The first CMBS auction had, when it failed in September, and you could see things were really slowing down. So I got a job at a developer in Minnesota, and then met my first investor there, or it was one of the interns there. We went and met with he's like, why don't we go meet with my dad? I met with him. We started doing deals together. And over the last 10 or 15 years, we bought about $100 million of property together. And then I have another family that I started a similar relationship with, did about a similar amount of acquisitions with, where we probably own about $100 million with each family. And then I've syndicated some deals to just individual investors, which is what I'm spending a bit more time on these days, because I would have people come to me and say, like people I knew at least, they'd want to invest 100,000 or 50,000 or 200,000. And I'd actually just turn them down because I wasn't really set up to take on other investors, but now we're set up to do that, and we're just doing only multifamily across the Sun Belt.
That's perfect. So you focus on multifamily. So you started, I think you mentioned before, it was 2005 is when you launched Breneman Capital, and now you've built this thing, man. This is good for you. You built it to 200 million in real estate. That is awesome. Roughly what deal size do you guys like to play in?
Well, starting out, I mean, yeah, we was smaller, but now 5 to 35 million, let's say. Biggest deal I've done to date is 33 million. But yeah, so it's sort of really looking, in that deal size, and then only multifamily and only certain types of multifamily. We're only buying in Phoenix, Dallas, and Austin. And just from our analysis, those are the best markets in the country for a variety of reasons. But a lot of them are pretty obvious in terms of just the job growth story, the population growth story. And then also we want deals we can add value to. So we're buying deals, usually not like the brand new, shiny new one, but not the super old one either that should have had like the plumbing and electric changed a million years ago. So typically the stuff we're buying is built in like the 1980s to, let's say, 2010, and it needs some form of renovation. And then our whole business is where we go in and then we'll renovate it. Sometimes they don't need renovations, and it's just a mark-to-market play with the leases. But that's generally the whole business. I mean, most of the deals we bought have been off-market. 80% of the deals I bought have been either off-market or through a repeat broker or a repeat seller. One thing that I've kind of figured out, or just coincidentally, I really haven't bought a lot of deals when it's like heavily brokered and there's like 10 offers or 20 offers on it. Like obviously you're not getting the best price in that scenario. So I've only bought 1 or 2 deals that way, and those ended up still being good deals. Just it's kind of timing, where one was like right before Memorial Day, and like 2019 ended up being everyone was already off to vacation or something.
Man, that's perfect. So you got timing, you got that locked down. You've got your buy box locked down, between 5 and I think 35. You mentioned before you used to do commercial, but now you're doing multifamily, specific in those areas that you listed for your own analysis. Shocking. Someone who has 200 million under management does analysis, does his homework. This is good. And so understanding your markets that you function in, understanding your buy box, those are all very powerful things that Drew has done to build his business to where it needs to go. So I'm wondering, as we transition, I'd like to spend the rest of this, our time together, talking about, let's just say, like 3 or 4 things that you find to be absolutely vital in not only running a company of 200 million assets under management, but also on your way up to the 200 million under management. You've probably learned a few lessons by now. Wondering if you'd be able to share 3 or 4 vital things that you found that have aided you in your success.
Yeah, I think, and none of these I knew early on. So this is just stuff I've learned, over the years being in the trenches doing the deals. But yeah, I think number one, and the reason I gave, let's say it's a pretty specific answer on like what I'm doing today. And if you would have asked me in 2009, what am I doing? I would have told you, I'll buy anything that's like a good deal in Minneapolis, St. Paul, which where me and my 2 first partners were living. And really anything. I mean, could be office, hotel, apartments, retail. And I wasn't specializing in anything. And those deals all ended up crushing it because we were buying in 2010. So like the performance was still excellent. Like our track record on our sold deals is a 25% IRR. We've done 13 full cash out refis where we buy it, we raise the value, and we can refinance out all of our equity by increasing the loan balance. So like we've done great, but like I would have done even better, I bet, if we would have just specialized from the get-go. I sort of specialized, but didn't realize what I was doing until maybe a few years ago. But I had only, from 2013 to 2020, I'd only bought 2 deals that were not multifamily. So really, like, number one thing I'd say is you want to specialize. Like, don't be a generalist. And like why that's important is, this is a competitive market, and you want to think how can you create an advantage? How can you create an edge? And when I was buying in 2009, I had no advantage over those other people. Because let's say maybe I'm competing with someone who only does retail properties, and now I'm dipping into retail. I'm doing my second deal ever against someone who maybe has done 50 of those. And so I became that guy that's done whatever 30 something multifamily deals now. So specialize, because you'll get better at it. You'll develop an expertise. It's easier too if you have a team. They actually know what they're showing up to do at work. Like we work on multifamily versus like whatever Drew brings in, we're doing today. And then two, if you do that, then you're known for something. And especially in the deal sizes we play in, most every deal is sold through a broker, but a lot of times off market. So the brokers know who do what kind of deals. And a lot of times they never even make it to like the full market. They might just send it to the 3 best buyers that are doing those kind of deals. So if everybody knows what you specialize in, from your employees to your investors to especially the brokers, that's going to help you a lot. Because then with the brokers, they're going to know you for that. And then I guess the next tip is like, you want to get friendly with the brokers, really be, mindful of your track record with the brokers, build a relationship with the brokers, focus a lot on your reputation with them. Where if there's like a minor problem at the property and you're buying it, my advice would be to think longer term and about the bigger picture and just let it slide and don't be nickel and diming everybody to death. I've sold deals to people where at the end of it, I was like, man, I never want to deal with this guy again. Basically, like they wore me out asking for little stuff all along the way. And then they wonder if I want to sell anything else. And I'm like, I don't know, probably not, and I have like 30 buildings. If he was like a great buyer, maybe I'd be like, hey, let's take a look at this one. I'll think about maybe selling it next year. So yeah, specialize and then, get close with the people who control the market.
Yeah, I love that. Yeah, you're to that example of a very difficult, we'll say client, but just counterparty. Well, you're always building a reputation. Which is just what are you known for? And if it's known for being annoying in a deal, so your reputation and relationships. Well, I think, and on the show, those who follow it, I say this all the time, is your reputation relationships are going to have the biggest factor on how successful you end up being, how well you run a business, all of those things. If you're a CEO or you aspire to be, a big part of being a CEO is building alliances and using your reputation to get people a lot more friendlier with your company. So if don't be that guy that Drew dealt with, you're building a reputation relationship in one way. And to Drew's point, could be a competitive edge in itself. Your reputation and your relationships could be one of those edges that you're able to exploit to win in your market.
You're very right. You're very right, Ryan. I mean, I could just keep going on that for a second. I've had my best, one of my best employees, before starting with me, he was working at a $50 billion private equity shop, and he liked what he heard in the interview, but he's a very cautious guy in terms of like how he does some things. And so he asked around mutual people, and everyone told him such really great things, where he always brings that up when we're like meeting people, when like, how'd you guys start working together? And he always brings this up, but it was having that good reputation with people helped. And I've got investors that way too, where I've literally had brokers refer investors to me, like passive investors that just put money into our deals, where it's like, hey, this guy was looking to buy this property. He doesn't know what he's doing. I know that you're a nice person and like are trustworthy, so I want to just introduce you to him. Maybe you guys could just work together. And it's to me, I just be how I normally am, and that sort of stuff keeps happening to me. So it was never like a strategy, but then I see people doing things that are counter to that, and I'm like, yeah, this is like not going to help. Or there's been times I've entered a new market and then I've asked for like, hey, why don't you call this person that works at the same brokerage company as you in Chicago and ask them about me? And like on one of those calls, one of the brokers said, Drew's the realest buyer ever. Like that was his referral. Like, you'll have no problems with this guy.
Man, I love that. So there you go. Your reputation relationships just smooths it out. I love it. And that doesn't come quick. We refer to those as long game strategies, building your reputation relationship. But that time is coming, whether it takes you 5 years, 10, or whatever. Those 5 or 10 years are coming. You might as well be a much better version of yourself than you are today. And that, my friends, are what will be a bit of a magnet, and it can pull in money and deals and partnerships if you manage it properly. So, and yes, Drew, I could go off on this as well. So to summarize that first point, integrity matters, but also your edge matters. And so if you have an edge, use it. If you don't, think about what kind of edge you want to have in your sector and then get to work building it. Maybe you go on podcasts. Heck, maybe you go get a PhD. I don't know what you need, but at the end of the day, what Drew's saying is it's better to be a specialist than a generalist, because specialists have edges, good edges, and you can use those edges to win in your market. So as we move on, what would be the second thing? Like, for example, I'm curious, now that you've grown this fund, just 200 million, that's no small number. Building an investment fund, a capital market, financial institution that you have, that is building a business. So the business of real estate investing, and for those of you who are just in other investment markets, maybe some of these things might work too. But I'm curious, Drew, when you've built your business, what kind of tools, tech stack, any of those things have you found that you would like to recommend as helpful tools in this industry?
Yeah, that's a really good question, Ryan. Because I mean, what's funny is for the first 15 years, my tech stack was like my cell phone and Microsoft Excel and my free Thunderbird email client, And now the thing is, once you hire people and then also you start doing these bigger deals, you do need technology. And so that's you need a good team and good technology. So for technology, number one, everybody underwrites these deals in Microsoft Excel. That's still just the best thing for any sort of financial analysis. We have you have a really great model that guy investment model that the guy from the private equity shop created, and they still use there for their $1 billion deals we're using on our stuff. But Microsoft Excel, but everyone already probably knows that. But then really what we're doing next to populate our model, the first thing we do, and this is something I had never heard of until 2 years ago, it's called Red IQ. So RED IQ. And what this does is it uses AI, and then also with what you teach it for how you code your revenue and expenses. So let's say a common issue, this is just a time saving tool. You might get sent a rent roll and a trailing 12 financial that is in PDF form, and none of the columns really line up right. So then when you maybe use your Adobe Acrobat to try to convert it to a PDF, it's just a jumbled mess. This can scan the PDF and then puts it, it's on their website, the application, and then essentially has everything laid out how it thinks you would want to lay it out. And it knows that by you changing the categories and recategorizing things in your account, and then it learns what you're doing. So a lot of times we'll throw in a deal, and then it'll just categorize everything how we do it, where we keep track of the other income a certain way. And let's say some people might put payroll into repairs and maintenance at a property, or they might have a payroll category. Other people might have the trash contract in utilities. Some people have it in the contract section. So we just want to get everything standardized though. So we can just rip through these past financials where we're able to dump into our model a T12, a current rent roll, the 2022 financials, 2021. Like we can just load it up and get it all sifted through in a matter of like a half hour, where before that used to take like a day. Just flows freely through the model and starts populating everything. Then we change it based on the business plan. But so Red IQ to clean your seller financials, let's say, definitely you need that once you start getting into these bigger deals. Because if you're just buying like 6 units or 4 units, you don't need it, because you can just rearrange that quick enough, and it's not, none of this stuff's that cheap that I'm gonna bring up. But it's like, but if you're doing a 200 unit, this year you're repopulating hundreds of items. Like this would make this well worth the money. I think if we canceled our subscription, probably people would be up in arms. That work here, they'd be, my people jump ship.
You'd be in trouble. You'd be on somebody's naughty list. Yeah. And what about, so you talk about populating models. This is a big part of all finance, not just real estate. Part of those is looking at maybe the financials of a company or an asset that you're trying to buy, but also the market data. Where do you go to get your market data in the industries that you work in?
Yeah, really 3 places. Like Moody's, they have a subscription where it's real estate data. And then also Yardi has a product called Yardi Matrix, where that has market information and in terms of like what they saw for rent growth in a given market. And then also they have predictions on made by economists and their financial models of rent growth. And they also have building level data where for larger buildings, they have the rental rates by unit. They have the unit mix. They also have some expense estimates. And then CoStar, which CoStar is basically in the real estate industry is trying to be like a one-stop shop where they have listings of deals for sale. They have news. They have all the data I just mentioned. Yardi has, for the most part, CoStar also has. And then they also have just breakdowns of supply, new supply in each market, vacancy rate, what's the cap rate in a given market. So like those 3 things, it's all quite expensive. So if you were just going to pick one, I'd say go with CoStar, because that sort of has everything. Where then if you want another source to double check, like then Yardi. But we've made some separate models of predictions on price appreciation, where one of these folks that works for me, their hobby is basketball analytics, and made a predictive bracket for the NCAA tournament optimization model. So he applied the same sports analytics to predicting price appreciation in different apartment markets. And almost all of that data that we pulled in was from Yardi and CoStar. And then we bought some census data by zip code. And so that, because we got to get it sliced and diced a little more granular to do this model that he made. But so depending on what you're doing, those would be the sources I'd go for data for sure.
I love that. And what about when you're doing the big deals that you do, either in real estate or any other asset class? Sometimes we have a fund administrator or investor relations or onboarding portals. Like, do you use any CRM or any kind of, deal platform, fund administrator, anything like that?
Yeah, we have my answer is just yes. And then next question. We're using a product called Juniper Square for our investor portal. And so what Juniper Square essentially does is that for every investor, it's like a Charles Schwab or brokerage account type login, where you log in, you see all the deals that you're an owner in, what your percentage is, how much money you invested, how much you've been paid to date. Depending if some deals, like you also put in like what's the net asset value if we sold it today, and can show like potential returns if it was sold. So it's a nice tool. It also, you can get your tax documents in there and investor communication sitting in there. So it's a nice tool. And I'd say that you really wouldn't need that unless you have more than maybe 20 investors, it's not, it's fairly expensive. So if some of this stuff, it really comes in handy when it's like, we want to pay out $100,000 distribution. And then this will create a one-to-one email with that investor saying, you've just received a distribution, here's your amount, and then update all those things and keep track of it in there. Where, otherwise you'd have to make a spreadsheet and track all that yourself and then send, if you got 50 investors, 50 one-to-one emails, and it'll take forever, where this you can do it in 5 minutes.
Perfect. And let's say I don't know how you pronounce it, the NCREF or NCR.
Oh yeah, I was telling you about that before. Yeah.
Do you use that, or like, how does that play into your overall data stack when doing due diligence?
Yeah. So I'm not subscribed to that, but I was able to get the data that they had. One of the guys who works for me has a master's degree, and then they was just able to get it from the school. And so what that NCREF is, it's a National Association Counselors of Real Estate Fiduciaries, or something like that is what the acronym is. But what most people know it for is it has a index that is the best thing to depict private real estate returns. So obviously for public equities, the best thing is the S&P 500, where you have the 500, largest companies or whatever it is. It is, as that's the average of the market. But for private real estate, you wouldn't really look at like REIT stocks, because REIT stocks are highly influenced by moves in the stock market. We'll say that, like, REITs are more correlated with the S&P 500 than with private real estate, where, so NCREF, yeah, they have an index. We were able to get that data that had the returns, and we went back and calculated the returns by product type from 1990 to 2020. And by product type, I mean multifamily, industrial, office, retail, because I always thought multifamily was the least risky, but I didn't know kind of where did it shake out return wise. And actually for all hold periods from 1990 to 2020, where you could have owned a property for 3 years, 5 years, 7 years, 10 years, across the NCREF data, multifamily had the highest returns for every one of those hold scenarios for every time period. And then there was and then it also had the least return volatility. So the lowest risk for every period, except for like one of the 50 different periods where retail or industrial had a less risk for one time window, but still lower returns. So yeah, that's important too. And then, yeah, we use, I think you're asking about CRM and stuff. Yep. Like Juniper Square, that's good for keeping track of your investors. But let's say you want to keep track of like your more business to business contacts, like your brokers or your insurance agent or your lenders. For that, we've been using Pipedrive, but really Pipedrive, we just like the interface and the cost to what you're getting. There's not really any one feature in that where it's like you have to use Pipedrive, but that's what we've used. I do like you can send a bulk email that looks one-to-one. So let's say you want to email 10 brokers at once, be like, hey, you got anything I should take a look at? Like you can do that as a merged email that looks just like it's from your email. So that's nice, but that's kind of a rare occurrence. You email 10 brokers, you're gonna get 10 phone calls. So you gotta be careful with that feature. So
I love it. I literally average 200 emails a day. So I feel your pain, man. So that's good. So you have a tech stack that helps you to run these deals and really manage and lift a lot of weight with the right technology. What about financing and underwriting? I mean, what have you seen? What do you like to see? What's going on that factor from the master Drew Breneman?
Yeah, I mean, I guess for financing first, I think probably a couple things. Like one thing where if you've never bought a property before, and you might get a sheet that says like, here's the loan program. It's 80% loan to value or a 125 debt service coverage ratio. So you start out and you don't know what a debt service coverage ratio is, and so you go, okay, I can borrow 80%. So you're looking at a 4-unit or whatever, it's your first deal. You finally get one you like, and then let's say you never talk to the lender about it, but you send it to them, and then they size the loan, and they go, we can only lend 60% on this one. And you're like, why is that? And it's constrained by the debt service coverage ratio. And so what I'm getting at is, I think what's counterintuitive, if you will, in maybe investing in real estate is you really actually need to start with the loan first and knowing what that is. So let's say I'm looking at this type of multifamily property. You to actually see what your returns would be, how much money this would make, you're going to need to get from the lender, what would my interest rate be? How long, if that's a fixed rate, how long is it fixed for? Is there any interest only term? And then also how is this loan sized? And this debt service coverage ratio thing comes into play in that what that's saying is, let's say they said, I want a 125 debt service coverage ratio. What they're saying is they want the net operating income of the property to be 125% of your loan payment. So you have an extra cushion of 25%. And so if you're buying something, today, most all deals will be limited by the debt service coverage ratio, because a lot of them, interest rates went up, and a lot of the properties that had no debt on it would make, day one, similar to the interest rate. So I can go through how to size the loan if you want to get real nerdy.
Yeah, let's get crunchy. We've got a pretty advanced community here, so it's all investment bankers, fund managers, entrepreneurs. Most people are pretty advanced here. So yeah, if you can crack that open on how you calculate and underwrite those deals, let's do it. Let's chop it up.
Yeah. So okay, because the other thing too, then to get into for this is, so I explained the debt service coverage ratio somewhat, but also the lenders, they're going to use potentially different rents and expenses and vacancy rate than you will. So lender underwriting. So that's the next thing you would need to actually, with my list of questions, you're going to need to ask how they underwrite all the stuff I'm about to go through. And you should also ask about the prepayment penalty. Let's save that for the end though, because I could do a whole prepayment penalties are very important. As you get better in this business, you almost think of the end of the deal more at with the loan than at almost what your interest rate is. But for loan sizing and how this works. So a lender, they're going to look at your in-place rent. So what's the rent today that's on the signed leases that's been actually paid? So if let's say we're July, and then they're going to want to still use what was paid in July for the rent. And then for the other income like parking and late fees, they're going to use a trailing 12, meaning what was collected over the last 12 months. So you might say, well, something that I will be able to charge more and do X, Y, and Z. Lenders don't care about that. They're just looking at what's there today. And so same thing in Chicago where I've did a bunch of deals. That market's always been really tight from a rental market standpoint. None of my deals ever had more than a 3% vacancy and collection loss in a given year. And so when I buy, I was assuming 3% vacancy and collection loss, but the lenders, they will assume 5% or more. So in Chicago, they would assume 5, but in a place where maybe the actual vacancy is 8%, well, then they're going to assume 8. So you have your in-place rents, your trailing 12 other income, your 5% vacancy rate. And then for the expenses, what they're going to do is they're going to take the trailing 12 expenses, just like the other income, plus they're going to do like a 2 to 3% annual increase to account for bumps. Oftentimes they don't give you an increase on the other income. So it's just, we're trying to underwrite this like a banker where it's conservative. And then in today's times where in the insurance market is real up and down or really just really up, that you need to get a real insurance quote. They want to underwrite your real insurance number. They're not going to trust the seller's numbers. They're going to say, well, maybe that guy's got a policy with 200 billions on it. He's got some sweet deal where his premium's low. So then they're going to use your real insurance number. And then for the property taxes, this is another common thing where the lender is going to underwrite worst case scenario. So let's say you bought a building and the assessed value went up, but it's under appeal. They're just going to do the worst case. So they're going to take your new higher assessed value times the most recent rates. So they're going to look up your actual bill and the assessed value and take what sort of the higher to be conservative. So you have your income, your expenses. So when you subtract your income from your expenses, then you have your net operating income, or probably better called your underwritten net operating income. And so let's say if that's 125,000, now you can only, and the lender requires a 1.25 debt service coverage ratio. That means the most you can pay towards your mortgage payment on a principal and interest basis is $100,000 a year. So then what you would need to do is you need to calculate, okay, based on my interest rate and $100,000 payment, how much can I borrow based on that? That's what you need to be doing, which sounds complicated. And I guess, haven't had to explain it like soup to nuts like that. I guess it is, but you'll need to do that because otherwise you're not going to know what the loan amount is. If you're just starting out, sometimes it's hard to get, a lender, they'll probably size a few deals for you, but if you just send them like deal after deal after deal to size, you're not buying anything. They won't continue that forever. So like on our stuff, we just do all this on our own. It's already in our spreadsheet. We have a lender analysis tab that sizes the loan. And then, the limiting constraints is the debt service coverage ratio or loan to value, whichever one kind of comes into play first. Some lenders also use debt yield, which is and they want to see your NOI divided by loan amount being a certain yield, but that's only certain types of lenders use that, and no one starting out will see that, so we don't need to overdo it with getting into that.
Yeah, perfect. And so key metrics on a multifamily deal, right? So we talked about underwriting and financing, and even building a company, the technology that you want to put in play. We've covered a ton, right? So Drew has been very generous, but I have one more question. What key metrics, when you see a deal, if people drop a stack of 15 deals on your desk, what are maybe 3 or so of those things that you like to see? Maybe even 1, I don't know. What are some of those things that just scream, we got to do this deal? What are those categories that you look for first?
Well, I will answer that, but I do want to go back to prepayment penalty for a second because I said I'd say that, and it's really one of the most important things. I had the guy I've used for most of my debt on my podcast, and who's done over at the time $12 billion of loans. By now it's probably 15. And the most important thing he said that whole podcast was, so his name's Steve Kundert, so shout out to Steve, was you need to match your loan up with your business plan. And one thing that has happened to me, to my benefit, is I have bought a bunch of deals from people who did not match up their loan with their business plan. So don't make that mistake. And so what I'm talking about is, let's say you are a developer, you just built a building, to use examples of what I bought. You stabilize the property, it's leased out, and now you need to put a loan on it. You're a developer, you you buy the property, you build on it, then you usually sell it. That's your business. But all these deals I bought, what the developer did was they put a 10-year fixed loan with a yield maintenance prepay on it. The reason they did that is you get more proceeds when you do your debt service coverage, loan sizing. If your rate's lower, you get more proceeds. And one way to get a lower rate is to take a unfavorable prepayment penalty. So these folks did that. And then they, a year or two goes by and they go, hey, I want to sell. And I bought like 4 or 5 deals this way. And some of my biggest deals have been my largest one was, and my third largest deal was as well. Loan assumptions, off market, someone with a yield maintenance prepay. And yield maintenance, it's a whole fancy calculation on if you pay it off now, maintaining the lender's yield. And bottom line on these deals, the prepayment penalty would have been 10 to 20% of the loan amount, depending on the deal. And these were, the $20 million loan and like a $9 million loan. So this would have been, $2, $3, $4 million on one of these. And so as I got better with the deals and let's say I bought a property and then I know I'm going to raise the rents or I'm going to renovate it and then I'm going to either sell it or refinance and put a permanent loan on. I look at that thinking I want the most flexible prepay. That's my number one thing that I'm looking for in this loan. So the most common loans I've done have been ones where the prepayment structure is, let's say 3% the first year, then second year drops to 1% and then 0 after that. So I do my business plan, it takes a year or two, I pay 1% or 0 to get out of the loan. And it's pretty much impossible to find a loan with no prepay in commercial. So that'll be something that'll be new to somebody who gets going and investing in real estate, or maybe you're already doing it and you keep doing all these yield maintenance loans or unfavorable prepay structures because you're getting a low rate. But I really like on the deals that I'm doing, I'm thinking prepay really first. And so that's a big tip, that I didn't want to gloss over. But in terms of what I look for in a deal, the first thing I would look for is the location. So really I've bought only in 2 types of locations is like where it's already established. So the nice neighborhoods, places that are already, you don't need to wait for the area to gentrify or anything. And then I'm buying the deal that I can just buy, renovate, and already command a nice rent for and create a lot of value on it because it's already in a good area. So I don't need to wait for the area to improve. I just need to improve that property to kind of match it up with the area. Or the other place I've done even better on buying is sort of where it's on the upswing, where it used to be rough, but now it's, let's say, like grungy, we'll call it, the Chicago neighborhoods, it's Logan Square, and it's these places where the hipsters are riding their bikes up to, and all the ramen shops and bubble tea places are going. So if you never heard of Logan Square, just look for where people are riding their bikes to, and with the bubble tea, like that's usually the giveaway. Even if, let's say, the deal, it seems like the return might be high, if it's in a rough area, in an economic downturn, your tenants they just have weaker financial situations. You might have to deal with crime on the property. So it could be hard to get good tenants or good, employees to work there. So yeah, I think location, I'd say first, where I need to be buying the right areas. And then I'm only looking at these markets that are really booming already in terms of the population and jobs. And then what we're trying to do on every deal, when I said we're doing these value add deals, is we're trying to solve for a 15% deal level IRR. But basically what that translates to nowadays is to hit those kind of returns on like a 5-year basis on a 5-year hold where you'll double the money and make 15 IRR, you need to create essentially 15 to 25% additional value on the property. So the metric in terms of metrics that you're looking for, everyone in real estate uses this term cap rate. And so if that people aren't familiar with that, that's your NOI divided your net operating income. So what the property makes if there was no debt on it divided by your purchase price. And so that's just a metric. The higher the cap rate, the more cash flow there'll be on the deal. That's also your yield on the property if there was no debt on it. So if, let's say, a property makes $50,000 a year and I bought it for $1 million all cash, it's a 5 cap, and also I make 5% as my cash yield every year. And so one way to compare how much value we're creating is this term unlevered yield on cost. And so like if you would say, like, what am I looking for? It's in a good location and the unlevered yield on cost is a certain amount above like today's cap rate. That's for the most part, I'm looking for that. And then, seeing what the IRR and equity multiple would be. And the reason I like unlevered yield on cost is it just takes a lot of the noise out. And so how that's calculated, I can walk through that, is that's going to be it's your net operating income when after you've executed your business plan, but in today's dollars. So what do I mean by that? Let's say you're gonna buy this property, the rents are $800, but when you renovate it, you can raise them to $1,200 in today's times. So what I do is then I'll make a new pro forma, so income and expenses, that would show $1,200. Then also, what would my expense be based on those $1,200 rents? Because now we would need to assume our taxes are going to go up, and also things that are based on revenue are going to also increase expense wise. Some things like utilities aren't going to change if you're charging more necessarily, or maybe could go down if you're putting in all new like low flow toilets. But we're not getting that deep into the utilities. We don't assume we cut any expenses usually ever. So so that you'd have your rents and your expenses into assuming no market growth. That's what the untrended term is. So someone says this is an untrended blank, that means they didn't also grow it. So like I said, the rents are $1,200. I didn't say, well, it's $1,200 today, but I put $1,300 in my spreadsheet because it's going to grow like $100 between now and then as well. So yeah, that's your numerator. So you're the top number in this equation here, where that'll be your NOI based on where we can stabilize the building. And then your denominator, instead of it being just your purchase price, we also need to factor in our other costs, like the renovation now. So that's going to be, if we could just snap our fingers and stabilize this building, that's untrended yield on cost. That's the new rents and expenses. And what would we be all in for if we could just snap the fingers, everything's re-rented, it's renovated, purchase price plus renovation. And then if people want to know how to use that, like let's say the market normally sells at a 5% cap rate. And then if I look at that and go, okay, I can stabilize this deal at a 6% cap rate. If you do the math, 6% divided by 5%, that's it should be 120% or 120. So then you subtract off the 1, I've just created 20% of value. So then that's what I said we're aiming to do. So that's how I look at it, because everyone in real estate uses cap rate. So then instead of going, hey, I'm into this for 10 million and it's worth 12, the better way to describe that to somebody that's already in real estate would be, hey, we're all in at a 6% unlevered yield on cost on this. It's a 5% cap market. So we got a big spread in there. Like that's how that all comes together.
Man, brilliant. So as we wrap things up, is there anything else you'd like our fans around the world to know, how to contact you, anything at all?
Yeah, but I mean, first of all, thanks for having me on. Like I said, love the Making Billions community and everything you're doing. I think I saw you like a big conference on Instagram or something where before we got going. So yeah, keep crushing it, Ryan. So
thanks, brother. Well, I appreciate that.
Yeah. So my podcast, the Breneman Blueprint, it's a real estate investing podcast. We get into some of this sort of like the tips and tricks. So like you're talking about, we've been talking about the back half of this, and just bring on people like me that are doing deals, lenders, attorneys, brokers. Also do some episodes for passive investors, like red flags and things to look out for. So just all real estate. That's the Breneman Blueprint, and that's on all the podcast platforms, also on YouTube. And then social media, I'm at Drew Breneman, just on every platform, I think. So just whatever you like, you can follow me there. And then for our company, Breneman.com. So B as in boy, RENEMAN.com. On there, you can find out about our portfolio, sign up for our newsletter. You can sign up to be on our investor list, where we raise money deal by deal for our investments. So then we send them out to people on our list, and then they just fill up from people on our list. Also have a blog on there, and then a passive investing guidebook you can download, which is basically breaks down everything you'd want to know about real estate investing. It's a 100+ page PDF. So we took quite a few of us took a few months putting that puppy together. So that's all on there, and it's just free to download and kind of get acquainted with us and what we do in real estate in general. So
yeah, brilliant. So you've been busy, man. Podcast. So go sign up for his podcast, download his white paper, which is basically a book. Let's be honest, 100 pages, man. There's going to be a lot. So if you loved what Drew has shared with our community, I know I certainly have, but if you've loved all of these things, that's just a sample. So you can go and enter his world and his orbit and really consume a lot of this stuff. So if growing into someone like Drew, if you want to be running multi-million-dollar deals in multifamily or just in real estate, go follow this guy. He's got Instagram. He's got it all, man. There's no reason why you can't enjoy some of the wisdom that he shared as he just gave us a sample. So just to summarize, become a specialist by exploiting an edge. Use tech to dominate your deals. The third thing that he talked about was building your financing package with the metrics that your capital partners find most interesting. In fact, deal breaker thresholds. So build yours to make sure you meet or exceed the thresholds that your capital providers want to see. And finally, just learn those key metrics on deal diligence and what they mean. You do these things, and you too will be well on your way in your pursuit of making billions.